the Start Your Own Business podcast. Hear inspiring startup stories and get reliable expert advice on how to start your business and get off to the best possible start. Brought to you by Startup Donut, helping small businesses succeed.
Hi there, thanks for joining us. My name's Fiona and I'm your host. Let's be honest, if you want to grow your business or achieve significant growth, you'll need money. It's likely you'll need to attract external funding from somewhere, unless of course you're already sat on a pot of money or your business is extremely profitable. There are lots of funding options out there, but perhaps the most common when you want to grow is to attract investment from an investor. If you're lucky enough to then go on and find the right investor, you'll benefit from the injection of finance, but you might also benefit from their experience, knowledge and contacts. In this new episode, I'll be joined by Martin Sock. Martin is CEO and founder of low-fee investing app Lightyear. I'll be asking Martin how you can get your business investment ready, where you can find suitable investors and what you need to do to attract investors. Martin will also be sharing some tips on how to avoid the common mistakes when it comes to attracting an investor. This series of the Start Your Own Business podcast is brought to you by Startup Donut in association with investment platform Lightyear. Before we meet Martin, let's find out more about Lightyear.
Life as a business owner can be unpredictable. You need a cash flow cushion for any bumps in the road. But this doesn't mean you need to leave your cash languishing in low-interest accounts. Instead, you can earn a daily variable rate of 4.6% AER with Lightyear's business accounts. Lightyear make this possible by giving small businesses like yours a solution traditionally reserved for the big corporates. Money market funds, managed by the world's largest asset manager, BlackRock. These are low-risk investments, usually only accessible with a minimum deposit of £5 million. With Lightyear, you can access them with no minimum deposit criteria. There are no fees to open, bank transfer into, withdraw from, or maintain your business account, and your money is always easily accessible. You work hard for your income as a business owner. Lightyear lets your income work hard for you. So rather than spending weeks trying to open an account with low rates and high fees, open a Lightyear business account in one day and start putting your money to work. Whether you choose to manage your company's cash on Lightyear's Slick app or the web platform, the interest you earn could mean you can hire a new employee or take that holiday you know you deserve. Visit lightyear.com/donut. That's donut, DONUT, to find out more and set up your account in just a few taps. And remember, when you invest, your capital is at risk.
It's now time to meet our expert, Martin Sock. Martin is CEO and founder of low-fee investing app Lightyear. Hi there, Martin. Thanks for joining us.
Hello.
I wanted to start, Martin, if that's okay with you, by exploring a little bit about your career and how you came to found Lightyear and how it's grown since those early days.
Yeah, I think you can take my career in effectively a big part of trying to figure out how to take technology and putting that into use of people. And I've been operating in the finance sector for 20 years. And most recently I worked in TransferWise. And I think TransferWise opened my eyes quite a bit that you can build something which is 10 times cheaper, 10 times more efficient, and your competitors are the biggest financial organizations in the world. And for me, for a long, long time, it baffled all these powerful organizations, why they're not able to offer a good solution for people, why it's so difficult to use, why it's so expensive, why there are so many hidden fees. I was part of TransferWise for 5 years, and we grow Wise as it's today, $10 billion company what managed to solve customer problems all around the world. And then after Wise, we realized that investing is actually a significantly bigger problem because it's much more difficult than transferring money, but it's also, there's a lot of fears, there's a lot of complexity in the systems and so on. And weirdly enough, we realized that if you zoom out and see Europe, there is 19 trillion euros right now invested in Europe altogether. And nobody has managed to disrupt it. So every penny of this effectively is in a bank somewhere and has layers and layers and layers of fees. And also it's like we started from retail side. It's really difficult to start investing. For most people, they don't know where to get started. And then if you come to the business side, it seems that weirdly enough, business investing or putting the money to grow on a business side is kind of forgotten. I don't know why. Maybe businesses are difficult, something else, but banks don't really offer a good service anywhere in Europe. So what we see right now is that there is a massive opportunity to actually elevate UK or generally like pan-European GDP, people's well-being, businesses' well-being, and that's our mission.
So your experience then of working kind of in venture capital and investment is from the fintech point of view, but I guess the process is much the same regardless of the sector that you're working in if you're looking for investment for your business.
Yeah, I think like there's so many different ways you can fund the business, but there is always many ways what are okay for you and many ways what are not okay for you. Like I'm not here to say that everybody should have VCs backing their businesses because it can be hurtful for you. Like the only reason you want VC money in is when you want to grow significantly. And I'm thinking about 10x every year for many, many, many years. Nobody is happy when the VC money comes in and you grow like 30%. So it kind of sets the pace and ambition and everything what you do. If you want to grow less, which is totally fine, businesses have different ambitions, then you have different types of funding. You have, sometimes there is not like a VC, but like more the private side of the things. Maybe there are more kind of angel type of like wealthy individuals who want to take a part of it. There's various different ways, but like you need to find your own way.
So you need to be sure that, you know, venture capitalism is the right way for your business in the first place before you start exploring it.
Oh yeah, 100%. Because it comes with an assumption, like nobody invests like in a VC world money getting a small return. So it's a rather risky kind of investment style. But that means also you need to get like 100x multiplier. But like getting 100x on your money is you need to achieve quite a bit of scale to do that. So means that you are pushing your company constantly to grow and grow and grow. So for us, it's totally fine because what we see right now is that Europe in general is so big and there is so much money and opportunity. Like there is massive kind of, I would even say arbitrage opportunity where you have all the money in the banks which are like not good for your investments, and then that money will move away from banks to the kind of low fee online platforms. This has already happened in the US. This hasn't happened in Europe. So this will happen. So we are getting the scale. For us, this is totally normal and right way to do that. And we also grow in the kind of realms what the VCs are expecting. But if I would like to do like more kind of casual business, maybe more business where I'm more in control and everything around that, then this is totally different types of financing what you need in a business.
So I think from like my experience and probably most people's experience, their kind of understanding of businesses seeking investment will come through TV programs like Dragon's Den and The Apprentice, and you see these ambitious young businesses coming and asking for money. But do programs like that actually have any kind of use for people that are looking to grow their business in terms of what lessons you can learn?
Absolutely. So I think there are different ways to think about investment. So one is always if you take the investment to get money. So there is some money coming in. Now there's a question of ratio between the ownership, what you're giving away, the money, what you're coming in, what are the strings attached and everything around that. But there's other forms of investments. So for example, you could have a lot of exposure. So you have a good product, you go to the TV, people love your product, you get money or not, but you're able to get elevation in your business through that. And this is like one of the big things what people often miss is like, even in the VC world, you get the money in, but like there's missed opportunities where you could effectively take these big names and showcase that like how their kind of big networks can elevate your business in various different ways. Sometimes you take in people's money who's like not like big amount of money. It's not a strategic investment in your business, but it's only because you want to get the visibility around that. So We often, if you raise money, we usually think about it in a way that we have one pocket where you have people who effectively invest just money, and then you have another pocket where you get the visibility, or sometimes you get an experience. So like for us, we have half of the TransferWise management team right now invested in our business. Why? Because we want to get their understanding how the world works, their experiences, learn from their mistakes and all that stuff. Because it all comes down to the fact that money will not make your business grow. Like how do you execute makes it grow. And execution has parts of understanding and visibility and exposure and all that stuff. I think like something what in the UK we still learn is how to create this massive exposure. I think we're still a little bit scared of exposing ourselves or selling hard. It's more of this American style of doing things. But there are good and bad things with that. But like generally, there's a lot to learn how to expose your business and make it exciting so people want to use you.
So moving on to the actual types of people who invest in small businesses, is there such a thing as a typical investor?
Not really. I think there's a lot of different characteristics. So if you're coming to the VC world, you have kind of angel groups of people who are usually doing like a smaller first type of investments. Depends a little bit of the angels as well. We have like typical angels talking of like tens and hundreds of thousands what they can put into your business. But like these days we have had already some of the really, really big angels who are able to do like millions and so on. So, but like angels, you can characterize them in a way that they invest their own money, means that it's much, much simpler. So there is a person, you talk to them, they put the money in, and then it depends heavily who's that person and how they want to interact with the business. And they're more hands-off, more kind of laid back in a way. But the more if you go to the VC world, then VCs are institutions. So that's not their money. That's usually somebody else's money, some pension funds and universities, whatnot. They invest into the VCs. And now you have investment committees, they have TCs, they have a lot of rules behind that, a lot of reporting comes with that. And I just recently saw that there is quite extensive ESG reporting for some VCs because they want to make sure that all their investments also make a kind of good behavior in kind of diversity-wise, environment-wise, and so on. So there is lots of reporting coming through that. And sometimes these are quite a lot. So you need to take that on as well. So, and again, if you are maybe earlier stage, if you're like just getting started, maybe you're even pre-revenue, it's more about belief-based. So there's like type of VCs who are willing to come in at that phase where you need to explain what are you doing, why are you doing it, how big can it be, like why you are the person who's going to win. And then if you're the kind of more mature you are, this kind of letters like ABC starts to come in, then this is the place where you need to showcase investments or like returns and how you're growing through these returns and how do you expand into different markets and so on. So there's different types of views there.
So it sounds from what you've just said there that actually it's not just established businesses that can attract venture capitalists or angel investors, that actually newer businesses can attract funding too.
It's actually wild. I have seen, I think recent years, a couple of people raising money without anything, without business, without having an idea. Their premise was that they will figure out in the next 12 months what to do. And they raised money for that. I didn't invest in that, but I know these guys and they're probably going to figure something out. But it's extremely risky in that sense. You have to believe that these particular people figure something extremely interesting out. But like generally, it's not even a crazy thinking. If you think about some like really big angel explained me that it's imagine if you are CEO of like huge company, like some massive world well-known name company, and then you have somebody coming into who's like exceptionally talented, proven at work and whatnot, and says like, I need to get like $500,000 because I have this crazy cool idea what could change everything. And should you invest into that person or not? And like, yeah, like it's actually quite normal for companies to take sometimes these bets where they internally invest and see if it's going to happen. Maybe they don't like actually put the money in, but it's more about they assemble the team and give them the time for like half a year to do that. And that's maybe $500,000 of the money. So it's not that crazy if you know that person. You're not the CEO, but like you're an investor, and that person comes in and they're proven and something exciting is happening, then like, why not give them money?
Yeah.
But there's quite a lot of risk on that parts of the field. So for me personally, like I do investments as well. For me, I like to invest into the people and the ideas. So like I like to go with the ideas, what makes sense for me, what excites me, where I can see like really big things coming out of it. And sometimes I invest in things because I think that they should exist in the world. Maybe I'm not ever gonna get the money back, but I invest in them. So it's like various different dynamics. So what I would say is that, or like why I'm explaining this is, there's lots of money out there, but you need to find the particular person or a company or a VC who aligns with you really well there.
Yeah.
Mostly these things come with massive scaling ambitions, but not always. But like mostly they come with the scaling ambitions.
Yeah. And what about sectors? Do investors tend to stick in their own kind of stream? Are there particular sectors that are more attractive to investors than others?
Yeah, you can slice and dice it in various different ways. So usually you have people who take stages, like either like really early stage or like already some proven stage or late stage. I see that there's a lot of companies who say like, we invest only fintech. So fintech, because I understand it for whatever reason, and I believe that's going to be the future. But I think recently you can see that you have these waves. Like today, everything AI is interesting.
Yeah.
Because people have seen that AIs can generate like massive revenues.
Yeah.
You can build businesses when you have 5 people and already have millions of revenue, or even more. So it's a kind of exciting area. So sometimes people, like today is big movement that like AI or nothing. So yeah, every stage is fundable, but again, there's a return question.
Yeah. So typically, how much equity would a small business need to be offering in order to attract investment?
It tends to be like this, somewhere like 10 to 30%. So I think like there is something what we need to be mindful as well is that there is a little bit of the European side and a little bit of American side. So Americans are more focusing on scale. So you come in, you say like, I'll crack the world and I'll give you like $1 billion company at no time. So people are tending to take a smaller part of the equity. It's kind of counterintuitive sometimes, but like they tend to take a smaller part of the equity to fund this business and help you to make it successful. But it's also important that you're able to raise next rounds of money. Because if you're giving a large part away, so I have seen many times where people are giving like 50, 60, sometimes 80% away, you have, in a VC world, these are like unfundable businesses. The problem with that comes in that it's rather important concept that the founding team has also significant part in the business. Because if founding team is not there and maybe you have like a tiny amount of business, you don't have the motivation to drive this business.
Yeah.
And if founding team leaves, then you're in a tricky position. So people usually don't tend to fund businesses where you look into the cap table, then most of the people are or like most of the money is in the VC world.
And presumably there's a risk anyway in giving away too much of your business anyway, because you're giving away control of your business. And, you know, if you're not the right person to leave it, presumably other team members who have greater stake in the business can move you on.
Yeah, like I think there's always this risk. The best way to avoid this risk is grow fast. So the faster you grow, the more control you can have. I think like this kind of famous examples in the world is like take maybe Facebook and Mark Zuckerberg, where he has raised significant amount of money over the times and he controls everything still. So if you're growing fast and if you're a lucrative business, then you have more control over this. But yeah, there is always a risk that you give too much away, you leave the control away. I firmly believe that like founders need to be in a business. There's like quite a different DNA on the people who start this, go through these rough times, figure out the product and move. These often are much more kind of incentivized, passionate about the problems than maybe some general CEO you can bring in from the other company. So I, for instance, only invest into the founder-led businesses, nothing else. I think that's a different dynamic.
Yeah. So how much difference can securing finance make to businesses?
Quite a lot, in a good and a bad way. Good way, like if you're able to raise capital, this capital can give you ability maybe sometimes not to think about so much of today's revenue, but you think about tomorrow's revenue. And like this is the way you should think about it. You figure out everything. How do you scale the business? You take risks on various different kind of growth angles or product angles, and it may pay off. But there's also a problem that if you take the capital in, especially if you take the VC capital in, and usually you have like this 12 to 24 months of runway then, and if you are not able to prove during that time that your experiments or plans paid off, then you are in a really difficult position. And this is the place where you can lose control of your business, or it actually can go bankrupt because you lost all your money and you're unfundable, you need to scale significantly back to survive. And that's what we have seen quite a lot in the recent couple of years, where people have gotten into maybe seed or A stage, but they were like taking too much money in, spending too much, and they didn't actually build a business. So if you're getting into the times when you need to raise another capital, nobody will come in, especially these days, today, where it seems that capital is rather expensive. People have gotten a lot of, like in the last couple of years have been brutal, and VCs have gotten a lot of kind of bankruptcies and mistakes happening. So there's not a lot of money into extremely risky businesses. It's more of like, okay, show me the numbers and let's go from there.
So is it possible to achieve growth without investment for most businesses?
100%. So I think it's actually good to think about that. You should be able to drive growth without VC money, or like without the investments. So I would even think about it that if you're taking external investments in, then it's more about accelerating your ideas instead of you only grow because of that money, because that might be problematic. You get like, it's a little bit like drugs. You have this so-called free money, which is not actually free, and you spend it and it seems that everything is working, but like fundamentally stuff needs to work as well. It has to make sense. You need to build a product what people want, that they're willing to pay, and it effectively what the VC money should do is that you see that all this makes sense, and now you scale into some position where you are able to support your own journey. I think especially in like 2020 and so on, money was like so cheap, so available. People made a lot of mistakes of taking too much in and gotten into the position where their exciting business maybe does not make sense if there is no external money in, and then it's a difficult position to be. So 100%, like again, I'm coming back to that, like not everybody needs to take money. I think it's totally okay and normal to grow businesses without external investments. So it can be quite a different business if you decide to take money in.
So you've decided you want to take investment in, hypothetically. What should businesses be thinking about getting their business into shape before taking that route? Are there things that you need to do to prepare first?
It depends a little bit. Like if you are just getting started, you have your idea, you believe that this is the cool idea and can scale and make sense, it's totally fine to go from like early days, you have a presentation and do this called pre-seed round. So that's one way of doing it. Another way of is that you prove like a general idea that like people love that, and now you can say like, hey, I have something what I can actually say that these particular people in this particular market are willing to pay that amount of money, and what I see in the future there is like a million of these customers, so I want to go after them. So it's like more a mature way of raising money, because now you're able to actually say what you're doing. And this is actually normal. And I suggest people to think pragmatically and think like a little bit out of the box how you can validate some of your ideas. So I can give an example. So we started really early. We raised a lot of money. But before we did that, we went on and found all the different investors we knew, and we were able to get access. And on a paper, we figured out what's the problem, what's the magnitude, what needs to be built to actually get these people on our platform, how do we solve this problem. And we took this idea, went back to these people, and half of them said like, nah, doesn't make sense. So we went back, iterated on a lot, and then when we got the confidence that this makes sense, then we raised money. We're a little bit different because we are quite regulated finance business, and everything takes like a year to get licenses and all that stuff. So we can't just build an app and go out there, or like spend a weekend and get some business out there. So we need to get lots of expensive people because licenses require that. Licenses themselves need a lot of capital to get that. So we needed this capital to get started. But even before that, we had this kind of mock ideas and mock market research and everything around in place that, okay, this makes sense and this is a big business.
Yeah. So I suppose it depends on what your business is doing, but for most of them, there will be some kind of groundwork that you need to do before going out there and looking for investment.
Yeah, I think like generally people should try to go quite a bit before they're going to start bringing investments in. Like I think that it also creates this kind of good behavior that like if you're building a small business, it's a difficult job. It's a difficult job because if you're, for example, employee somewhere, then you do some part and then you're like one element of the bigger picture. And now you're going to be, okay, I'm going to build my own business. And all of a sudden you are like janitor and HR.
You've got all the hats to wear.
Business. You have everything there. Yeah. And it makes sense to try to kind of minimize everything for a moment, like, and also figure out like who's the customer and why is the customer there and what you can offer in a scrappy way.
Yeah.
Because it's easy to spend money. It's hard to be scrappy. And I think like all the business owners know that you need to extend the runway. You need to figure out how you can find efficient ways to operate your business or learn about customers or get in front of the customers and so on. And sometimes if you take money too early, it can be kind of opposite effect because you're getting stuck in this good environment where you have money on an account. If you don't have money, usually people start to move. If you have lots of money on account, maybe you don't move that fast. So I definitely suggest people to get rather good understanding, and maybe you don't even need investments. Maybe you can figure out like customers come in and start paying right away, and then you don't need to report to anyone, and you can build your own business and fully control that, and then you can decide. So for us, we have effectively every single time we have raised money. So we have raised 35 million total, but every single time we raise money, we want to raise money because we want to, not because we have to. And there's a big difference. The moment you have to raise money, your terms, what will come with that money, are significantly worse. You might be giving away too much control. You maybe are not able to build the things what you want to build because there are some other voices are coming in.
Yeah.
But if you want to raise money, then you are driving in a driving seat. Then you can say like, I have these things, and if you want to join my journey, then you can invest in that. If you don't want, then that's fine. I'll find somebody else. So you have a lot more control over the business.
Yeah. Another question is around how much people are asking for. You often see this referring back to programs like, Dragon's Den. They say, oh, well, I want £1 million to do X or Y. There's a careful balance, isn't there, between how much you're asking for and sort of what you're going to do with that money and what that will then achieve for the business.
Yeah, that's a difficult one. I can give you two answers here, which are like kind of polar opposite to each other. So I think there is one part of the people who say that you raise the money you can. It doesn't matter amount. If you are able to raise money, you will raise the money. So these are more maybe aggressive type of the people who are, if money is cheap, you take everything what you can and then you'll figure it out.
Yeah.
And then you have like other kind of school of people who say that you raise a minimum. And the reason to raise the minimum amount of money is that you are not giving a lot away. There's more control over you on your own business. You have more focused what you're building and so on. So there's like two wildly different parts of it. I think like the truth is that it's usually pretty hard to raise money. So if you're decided that you want to built that type of business, and somebody comes in who has a good alignment with you, then it's definitely worth having a conversation. And then you can figure out like, where do you go? Usually people raise like 15 months to 24 months or something, like a couple of years into the future.
Yeah.
Not too long, because if you have like too much money that sits in a bank account somewhere, doesn't really make sense. If you have too little money and you're not able to get your goals done for the next round, because it's rarely that you raise once. It's usually go like step by step and more and more and more. Then if you're not able to get your goals, then you're also a difficult situation. So you need to kind of get the balance there, I would say.
Yeah. So what are the key things that will attract an investor to your business?
If I'm really brutal on this answer, then your ability to drive a multiplier for them. But if you're having this discussion with people, then there's a lot of different answers. And these answers come in like this particular sector, or you have particular knowledge or so on. So I think like generally like how people think about your business is, are you building a scale? So do they believe that you're able to build this, like something with scale a lot? Do you have some expertise of understanding what others don't on this particular area? Is the area where you're operating interesting enough today? Sometimes like new waves are coming. We have seen cloud wave, we have seen AI wave is happening right now. We had the last mile wave and all this stuff. And like sometimes like these waves have these characteristics. It's a bit of the bullshit show. People are like, oh, this is the most exciting thing, it's going to change everything, so all the money moves there. Is it true or not? I don't know, you can argue that in a way, but it also comes down a lot to the team. So who are the people in your particular team? So why these people think, or like why investor believes that these people are better than others? Or do they have a track record? Have they built something similar before? Have they been a part of the scaling business before? Are they world chess champion? Whatever. So something that you can prove. So like this kind of team, market, business, scale, and is there some magic behind it?
When you say scale, what do you actually mean by that? What kind of growth are you talking about?
Multipliers. You need to grow multiple times every single year for many, many years. So if you're growing, if you're a really, really small business and you're not able to grow 5x, then it's like in a VC world, it's a little bit difficult. So the kind of scaling angle, this is kind of exponential growth, what people expect. So why it's important, maybe it's like it's good to discuss. If these type of VCs invest into your business, they invest actually many, many businesses, and most of them will fail. So if most of them will fail, then these particular ones need to do really well. So you just need a couple of them who will do 100x of your business. So if you have a fund of 50 million and you invest like 5 million into 10 different startups, and if 9 of them will bankrupt and one does 100x, then you're golden. So this is a little bit more into that, but like this is general math in it. Means that they're forcing you to drive like multiples every single year. And that creates quite a different business than maybe a typical small business who doesn't have external investments or external investments with like this multiple range in it. I'm just always mindful that there's a lot of businesses who maybe have investors who don't need to this multiplier. These are more, they want to have a stable growth and they want that business to exist and all this stuff. But VCs are brutal in that sense that they need this big multiplier.
So another thing that I think business owners forget is that when you attract external investment, those investors will be looking for an exit route to realize the capital that they've put into your business. So is there a typical time scale on that for most investors?
Yeah, it depends a little bit of the fund, and also a little bit of the business, what you're building. The funds are generally like 7, 10, a little bit more years long. So it means that typically these funds need to get their money back in one way or another. There are quite many ways to get an exit. There is a way to exit, like IPO is like the public one, but like these are the big ones and not everybody gets there. There are some markets where IPOs are much more common than, like for example, in the UK there is rarely, like there's a couple of IPOs, but if you go to Sweden, there is like a lot of small businesses actually IPO. But like again, it comes from the market and dynamic. But these are like quite big exits in that way. There's also ways like somebody acquires you, you sell your business for good or bad.
Yeah.
You can have like good exit or bad exit because of that, because you're sold because you couldn't have like make your business work, or you're sold because somebody really wanted your business. You can also get like a partial exits. Partial exits, like your early stage VCs can sell their shares to the maybe more mature VCs or somebody else, and like it's not that the full capital will change the control, but it's more of maybe a couple of VCs or maybe a couple of early employees or somebody will do the secondary where they sell some of their shares or most of the shares. There's like various different ways there.
So different exit routes. What about floating on the stock exchange? Might that be another route for them?
Yeah, like absolutely. If you're going into the stock exchange, you are becoming a public company, and the public company is quite a different beast in that sense. Like you have quite rigorous auditing requirements, finance requirements, but also a lot of things what you can and can't say, and the company will run in a little bit different manner. So I see quite many companies are going into this public route, and it's fine. But you need to be mindful that it will change your business as well. So you shouldn't go public because you just need money, but because you should go public because you want to go public, because that will change a little bit the nature of the business. Like name says, you are really publicly visible. Everything is what's going to happen, and like public markets, like businesses which grow in a stable kind of manner year over year, business gets better and stronger and so on. Startups are not really suitable for public markets because startups can go up and down, left and right and sideways and any various direction, and usually public investors get scared of that.
Yeah.
So you have a little bit different kind of mindset there.
And what about if the business isn't successful? You've said, we're going to grow this many times and you don't achieve it. What happens then to the investor's money?
That's a big question. It might happen that everybody lose everything, but it also might happen that you sell the business and your investors get everything back and you get nothing. So it comes down to a typical investor agreement, which is there's this tranches where the later stage investors typically have some kind of ruling that they will get the money back first, and then you have second tranche and so on and so on, and then you have in the end you have like a founders and employees and so on. So sometimes you have these weird things where you have successful business what sells for 100 million and founders get nothing because they maybe raised 100 million to get there and all the money goes to the investors. Or maybe they raised 50 million, but the contract is written in a way that investors get 2x of their money back. So there's always a risk that the business is not going to make it. The outcome can be like total failure, nobody gets anything, but there's like various different shades between there as well.
Yeah. You talked about this briefly earlier about the other benefits beyond just the money of working with an external investor. What other things can bringing outside investment and investors into your business bring to you?
So I think like the main ones are exposure and contacts. And the contacts in a couple of routes. Like contacts can be at one point you need to raise another round. So are you able to get access to the next set of VCs and investors? Are you able to attract them in? Is your previous round investors convinced that you are still exciting thing and they still continue investing in you and they will make intros for you to the next set of people? or if they say like, ooh, we don't know, we don't want to invest in this round, then you're actually in a difficult position. Then the new investor needs to assess that why insiders are not participating. So, but like that's one part of like connections.
Yeah.
Like in this world, there's thousands and thousands of investors everywhere. So are you able to find the ones who are believing in your business and in you and in this particular stage and so on?
Yeah.
It's rather important. The second part is exposure. Like we, maybe one example for us is that we have one investor who has given us much more exposure than anybody else. So one of our last round investors is Sir Richard Branson. And while he invested like a sizable amount of money into the business, he's also so well connected and known name that it's so much easier to explain your business for a next set of people. Because, Sir Richard is already here. We also have Lightspeed Venture Partners, which maybe doesn't tell much for like regular business or like people, but it's one of the biggest VC firms in the world. So in some of the groups of people, this is really big name again. So again, you can this helps a lot. Because for me, many times you're able to build a good product, but the problem is still distribution. So are you able to find the customers you want to your platform? Are you able to explain them what you're doing and so on? And every little helps. And like these kind of names often helps. And sometimes third is like expertise. We one of the founders of one of the biggest KYC or know your customer type of products is our investor. Means that he scaled from 0 to $1.5 billion. So now I'm able to learn from him what he did, what were the mistakes, what are the things I should be expecting in the future, and so on. Super useful again.
So I suppose it's handy to look out for people that can either, bring the money or bring the experience, or perhaps experience of markets and sectors or things that you're lacking.
100%. Because I think, again, like a big mistake what people do is that this typical traits is like, I'm not going to tell anybody about my idea because maybe they steal it. Like, nobody cares. Like you should do the opposite. You should go and tell every single one, and you should tell it in the TV and so on. And maybe somebody's excited enough about you that they're going to want to be part of you, to join you, invest you.
I want to get on that journey.
Yeah, exactly. And you should go and shout on every single roof, because in our minds we are so important and figured out, but like reality is like nobody cares. There's big effort from everyone who's successful getting themselves in front of you and explaining why the business is there.
I wanted finally, Martin, to ask you if you could give us your top 3 tips for small businesses that are looking to attract significant investment.
If you're talking about like acquiring investments from VCs or angels or whatnot, make yourself visible. Like everything what proves that you're able to be different. You have some expertise. People want to see that. It's super important. So imagine if you are walking down the street and some guy comes in and says like, "Give me $1 million," and you're like, "Whoa, who are you?" But at the same time, you have seen this guy many ways, like in the TV or news, or somebody's talking about it. Like if you made yourself visible, everything is much simpler. Second, hustle. Like it's, I think it's a kind of general European trait where people are afraid of hustling, and if they're going out and it's like, 3 people said that this business doesn't make sense. It's like, yeah, sure. Like I know people who have pitched 100 times and nothing happened, and 101 they got money, and now they're actually a $10 billion company. So like you need to go and find, and there's 2 parts of it. Like one part is you hustle, you make yourself visible, you make contacts, but you also learn about your own business. Like the more you talk about, more you share about, the more critique you're getting, you're like, okay, is it fair? Or should I learn? Or should I think about differently? And so on. At one point you figure it out, and it's super useful in that process. And maybe the third one, it makes sense to be ambitious. Like the world is I would say, much bigger and much crazier than you think. We often live in our bubble. We see the people around us. There is so much more diversity. There's so much more people who have different ideas, ambition, and whatnot. So I can give you an interesting example, like how I started fundraising for Lightyear. I started fundraising 2 years before I had an idea of Lightyear. So the way I did it was I was already left TransferWise, and I effectively figured out all the people, all the investors I know around the world, and called them up and said, like, I'm coming. I want to know what you know.
Yeah.
So I flew to Germany, UK, US, various different coasts, and sat down with people and it's like, tell me everything what's exciting right now. Tell me why it's exciting. Do you think what's the future technology?
Yeah.
Where do you invest? And make me all the intros you are willing to do. And then you're going to go and talk to these businesses. And I spent a lot of time trying to figure out what makes sense and what doesn't. I didn't raise any money. I didn't have an idea of Lightyear. But the time when I got into the place, I was like, oh, investing is incredibly broken. There's a huge market opportunity and nobody's actually doing that. And they're forgetting a lot of customers. Then I want to raise money. Now I had this notebook full of names who already have seen me and we have talking to each other. And that was so much simpler. And if like the next question, what you're asking is like, am I somewhat special that I'm able to do that? No. Like, it's weird. If you knock on the door, sometimes people open it and they're willing to speak to you. So if you do that enough, then you're able to build your own network and hustle through that.
Yeah, that's brilliant. Finally, before I let you go, can you tell our listeners where they can find you and where they can find out more about Lightyear, please, Martin?
Yeah, you can go lightyear.com. That gives you everything you know about investing in various different markets. In the UK, we have business side of investing or private, everything, tax advantage accounts, ISAs, and so on. And we operate actually in 22 markets. So wherever in Europe you are, you're able to onboard into our business. You can find me, it's probably easiest to find me in LinkedIn. So Martin Sock at LinkedIn. Just contact me.
That's fantastic. We'll make sure we include links to all of those in the summary notes that come with the episode. That's brilliant. Thank you so much for talking to me today. It's been really interesting.
Thanks for inviting me. It was a pleasure.
Take care.
Bye.
Bye-bye. Thanks for listening today. If you're considering bringing in outside investment, hopefully Martin shared loads of great information and advice there that will help you on your journey. We'll be sharing links to related advice and resources from across the Donut sites, plus links to Martin and Lightyear in the summary notes. You'll find these at www.startyourownbusinesspodcast.co.uk. Before you head off, if you're enjoying the show, please hit follow. If you're listening on Apple Podcasts, follows on the top right of the show page, and if you're listening via Spotify, follows just under our logo and title. Hitting follow will make sure you're notified about new episodes as soon as they drop. All that remains to say is another big thank you to Martin for his time and insights today. Until next time, all the best.